DRD Gold has come out with numbers this morning. We now catch up with the CEO, Niel Pretorius, live from the JSC, where we find him. Niel, a very good morning to you. I see you are trying to appease investors with a 50% increase in the dividend. Is that a deliberate attempt to try and make everyone happy, or genuinely you guys have got cash and you can give shareholders something back?
We made a bit of money this year. Cash position improved quite a bit. And it's the fourth year in a row now that we've paid dividends. So we also want to establish, I think, a reputation as a dividend yielding company.
So let's look at those results, Niel, before we go into the full year numbers. Let's perhaps begin by looking at them quarter on quarter. What did you see in terms of increasing output and also just in terms of managing the costs?
We compared this quarter with the same quarter in the previous year, and quarter on quarter production is up 2%, revenue is up 21% by just over 600 million rand, and operating profits also 21% higher at 110 million rand. And then the year-on-year numbers are also quite satisfying.
Indeed, the year-on-year numbers are quite satisfying, and I'm seeing here, you mentioned particularly Ergo and Blyvoor, and we're talking here about an increase in terms of the output that's up 29%. Sorry, the gold output is up, is it 10%?
37% for Ergo, 10% for the group, yes.
Indeed, and revenue is up 29%. So all in year, it's been a very good year for you. What were the major drivers here?
Well, obviously the gold price went up quite a bit. Our revenue is up 29% to 2.5 billion rand. And then the fact that we produce more gold also helped. Gold production year on year is up 10%. All of that contributed to a very healthy cash inflow. The net cash inflow for the year is up 504% to 223 million rand year on year.
And the rand gold price up 15%. I mean, all the time we hear gold producers talking about the strong rand and also talking about surging costs in South Africa. And here we are, 15% up on the year is not bad at all.
Yes. Well, remember that we've changed the setup of our business quite significantly. We're more into the recycling of old tailings dams now, which is a far more predictable model. It runs more like a factory than a mine, quite honestly.
And those costs, how did you do it? 8% up compared to last year, when we know Eskom this year ramped up prices by more than a third across some of the industries.
Yes, it's a lot to do with the fact that gold production is up. So obviously your unit costs get diluted by the increased number of units that you produce year on year. And it's as I said earlier, it's a mechanized process. 66% of our gold is from a mechanized process. I think it's easier to contain your costs in that regard as well. It's not very labor intensive.
So let's talk about Ergo and where it's going from here. I mean, you are talking about a 200% to 50% increase in the operating profit margin there. How much more can you extract out of that business?
Well, by the end of this year, we would have completed a 320 million rand consolidation of our entire surface footprint here in Johannesburg. It's a 50-kilometer long pipeline. It increases the volume capacity of Ergo by 600,000 tons a month. It assists us to phase out 2 of the smaller plants. The plant itself is also being refurbished. So that'll help, I think, with unit costs, further help with unit costs. And then on top of that, we have an in-house research and development team, and they've come up with quite an interesting concept, which might assist us to also increase the efficiency at that plant quite considerably by up to 25%. That will require technology investment, and I think that will be our focus in the next year. From the next calendar year, I think implementing or testing the technology improvement will be our focus.
Yeah. Now, when you talk to investors, the one recurring theme is that the South African gold industry is facing a lot of headwinds. Among them, we've just spoken about some of the costs associated with Eskom. We also talk about the strike action across the industry every single year. We also talk about the whole chat around nationalization, etc. And yet you seem primarily focused on South Africa. Is there a time when you look outside?
South Africa and Southern Africa. We increased our footprint, our exploration footprint in Zimbabwe in the last 3 months by just over 20,000 hectares. We have a 2-year option over a 20,000 hectare leasehold. We also have a presence in Mozambique. When I say presence in Mozambique, we have resources there looking at opportunities. So I think going forward, we would pretty much focus on optimizing our existing footprint and also looking at opportunities here in the Southern Hemisphere. If the situation in Zimbabwe is as bad as it's going to get, then from our perspective, it's actually not bad at all, because we have a 50-50 relationship there. And then there seems to be policy clarity coming out of Zimbabwe insofar as the indigenization process is concerned.
Yeah.
We don't have to dilute. We already have an established relationship along those parameters.
Yeah, but 50%, does that work? I mean, you essentially getting into a joint venture with guys, perhaps we may not have the money. I mean, we all know about the liquidity crunch in Zimbabwe.
Well, the fact is that the resources in Zimbabwe are shallow resources, they're high grade. A lot of that one can extract by way of gravity-based technology. So at this stage, it's pretty much a pay-as-you-go process. I think once we firmed up on our resource, it will probably be the sort of resource that would be able to be financed by way of debt funding and maybe a little bit of capital input. But there are always instruments to do the financial structuring of such a project.
Creative. Niel Pretorius is the word that you'd have to go. Thanks very much indeed for joining us this morning from our JSE camera.